Another quick video today. Still very busy with university work, but try and squeeze out a quick video this Friday evening. So today I'm going to just discuss candlesticks and how these can be used as a technical indicator. So I'm on a website here, and this just gives a brief summary, so I'll read this for you. So the Forex candlesticks originated from Japan a very long time ago, and they have become popular since then. What makes them the preferred charting type for many Forex traders is that every single candlestick contains information about the opening price, closing price, highest price point, and lowest price point for the given period. And when you're on your trading software or website, you can set your own period, so you can get a candlestick for maybe a second's too short, but you can get a candlestick for a minute, for a week, for a month, for a year. And normally they're used for trading, so they're used for the shorter time periods. Now, these Japanese candlesticks often form patterns that predict future price movements. Some of them predict bullish price movements and others suggest bearish price movements. So a bullish price movement just means trending upwards, and a bearish means trading downwards. They may appear as single, 2 or 3 candlestick patterns. And then in this website it's going to go through the most common candlestick chart patterns, but there's a lot. And so I would suggest that you go and do some further research yourself if you're interested in using candlesticks as a technical indicator. I think it's much better than using the lines. I do think you get more information out of these. So here are the most common candlestick chart patterns in Forex: bullish candlesticks and bearish candlesticks with images. So we'll go through the bullish candlestick patterns first. And also I'll just briefly explain on this bit here. So say for example you have a red candlestick. So here where my mouse is, I know it's only small, but here where my mouse is moving around at this point is the lowest price that the currency was in this specific period, and here is the highest price point. And now, because it's a red candlestick, this means that the opening price was here and the closing price is here. And so that's essentially what that means. And so this isn't accurate really, but so on here, because it's green, this would then suggest that here is the opening price and here is the closing price, so it's an upwards price movement. And there is another form of candlesticks as well, which I'll go through probably in the next video. So candlestick pattern. So it can either look red like this or green like this, and this is a bullish exhaustion slash hammer. So this is a candlestick that has a long wick underneath it and a tiny body at the top. This candlestick could either be bullish or bearish. What makes it out as a bullish candlestick pattern is its small body sitting on a long wick. So next one, bullish engulfing. So this is this pattern, and it is made up of 2 candlesticks, a bearish followed by a bullish. It's called a bullish engulfing because the size of the bullish candle completely engulfs the bearish candle before it. Bullish railroad, and so this one, made up of 2 candlesticks of almost equal sizes, a bearish followed by a bullish. When they follow each other, it is often a sign that the market is taking a sharp turn to the uptrend. I don't know if I can pronounce this. Bullish Marubozu, probably butchering that, but it's a long bullish candle with no wicks or negligible wicks, which would suggest an uptrend continuation. And next one is Morning Star. and this is here, and this is made up of 3 candlesticks. The first candlestick is bearish. The second candlestick is a very small candle with a negligible body and 2 little wicks, and it looks more like a plus sign. The third candle is a bullish candlestick that suggests a turnaround in the market bias. The bullish candlestick doesn't always have to be as big as the first bearish candle. Next, 3 white soldiers made up of 3 bullish candlesticks with little or no wicks. This suggests a bullish continuation. And then next, 3 inside up harami, and it looks like this, made up of 3 candlesticks, a bearish followed by 2 bullish candlesticks. The first bullish candlestick after the bearish candlestick is small compared to the previous bearish candlestick, but the next bullish candlestick engulfs the bearish candlestick to suggest the market is making a strong move to the uptrend. Bullish tweezers. Tweezers are almost similar to exhaustion candlesticks, only that bullish tweezers come in twos and often have shorter wicks. A bearish candlestick comes first, and it's followed by a bullish candlestick. And now for the bearish candlesticks. It says all bearish candlesticks patterns, but there is more. So bearish candlestick patterns in Forex are the direct opposite of their bullish candle counterparts. They suggest a continuation of a major downtrend or the beginning of a new downtrend. These are all the most common types of bearish candlestick patterns in Forex. So the first one, bearish exhaustion / shooting star, and it can be red or green. And it's a candlestick that has a long wick above it with a tiny body underneath. This candlestick could either be bullish or bearish. What marks it out as a bearish candlestick pattern is a small body underneath a long wick. Bearish engulfing. So, I mean, to be honest, these are kind of self-explanatory because I've spoken about these in the previous. So these are just the inverse of what we spoke about, pretty much. So yeah, so these are all the inverse. So yeah, so we'll move on to the neutral candlestick patterns. So the only common neutral candlestick patterns in the doji, so yeah, and the doji is the name. The doji forms when the market is undecided whether to go up or down. In the end, what forms is a candlestick with a small body and short wicks above and below the body, so any of these. But these can never be like seen in a vacuum because there'll be other candlesticks going around and you have to analyze all of the information. So I don't know what this is, but I'll just read it. So still on the candlesticks, because of the way a candlestick is derived, the opening price of a new time period is often close to the closing price of the previous period. This makes the Forex chart look like a continuous flow of candlesticks in trends moving up and down. Trade opportunities around in these charts. A common anomaly on the charts is when there is a gap in Forex prices, but even this anomaly has trading opportunities for those who know how to interpret them. So I'll probably go in gaps. I'll probably speak about gaps when the price gaps in a future video, but you can also research this yourself. Just type in trading gaps explained or something along those lines. And so yeah, in conclusion, before there was the MT4 trading platform or even computers, all of these candlesticks patterns have been there until today. They still do a great job at predicting potential price movements. However, just as it is with many other Forex trading tools or concepts, Forex candlestick patterns are not meant to be used in isolation. As I said before, you may have to combine them with some other Forex trading tools to get the best out of them. So you can put like an RSI on there or a moving average to get more information. By the way, if you easily get tired of staring at Forex charts, what you need to do is this. So they offer like a chart overlay indicator here as well. Let's just have a look what this looks like. So they've got this on here as well. I'm not too sure what this is. I'd have to look into it more. But yeah, so thank you for watching today's video, and we'll call it at that. Cheers.